Welcome everybody. It is July 6th and we are in the heart of a new trading month in the middle of the summer after a hopefully wonderful and safe July 4th holiday. My name is Joseph Kizik with the Kizik Group Securities offered by Money Block, and this is what's hot on the open here at MarketStream.live. And it has been quite an interesting opening. The first couple of hours have the markets to the downside. As a matter of fact, you take a look at the fear index, the volatility or VIX index, that's currently up a full point, and it's challenging its 200-day moving average above its 20 and 50-day moving average, which we've seen over the last couple of sessions, now firmly above. Let's see if that'll hold. And traditionally, this is a mean reverting type of instrument, meaning that it comes back to where it has been historically been trading over the short term, which is in that 10-11 range. So now that we've broken out, we're going to see if there's some upside. What are some of the notable reasons? You've heard the headlines out of North Korea. You continue to hear mixed messages from different central bankers, whether it's the Fed here in the United States or the ECB or the Bank of Japan or the People's Bank of China. Bottom line is there is a huge fear universally that inflation isn't on a movement to the upside as these central bankers have anticipated. They're all coming out with very hawkish statements. Not only are they saying that they believe that this short-term lag in inflation is short-term, but they also believe that their forecasts going forward are spot on, and they're going to continue with their rate increase policies going forward, at least at this juncture. Now, the Bank of Japan kind of put a little contra piece out there. They actually lowered their inflation forecast going into 2018. So the market's kind of been pulling back, and some of the notable moves, let's say the Dow Jones. Dow Jones is down 84 points, coming off of its bouncing off of its worst levels, but it's challenging that 20-day moving average. So if you want some context here, you're worried about your portfolio that has some blue chips. On the short term, the bulls are still in control. On the intermediate term, the bulls are still in control in the Dow Jones. And in the long term, until we get below the 20-day, which is this green line, and the 50-day, which is the red line. In other words, a break of 21,346 and 21,151, the bulls are still in control. If there is a break of these levels, that's where we start to look at our portfolio and say, is there a trend shift? Are we looking to either take some profits off of what has been almost all-time highs that were hit over the last couple of weeks? Or do we start looking at maybe adding some positions in, especially if we do continue to get an increase in implied volatility, as long as you have context. Now, the diamonds, again, moving lockstep, about 1/10 of the actual index, and then you see the futures are down. Now, taking a look at the S&Ps are down 13. Now, this is the biggest move we've seen in the S&Ps in quite some time, and as a matter of fact, it's been in about a week. We see that it challenged its 50-day moving average and has broken through its 20-day moving average. The battle has begun for the S&Ps. Some of the notable reasons are tech. Large cap tech is under pressure. We're going to get into that in a minute. What is holding this market above the 50-day moving average and what was holding it above the 20? Finance. Finance and firming of energy names. The finance sector, with the pullback in bonds, in their bond prices and yields increasing, finance has been a silver lining so far. It is holding up these markets with the S&Ps down basically 0.5% across the board, both in the SPX cash, the spiders, which is the ETF, and the futures. Now, taking a look at the NASDAQ 100, down 36 points. That's good for 0.6% to the downside. Tech has been the most negative market. This has been the leader, and now it is leading to the downside. This is something that we're going to want to watch. If tech cannot firm up and get above the 50 and 20-day moving averages, that means that we could see some weakness that we haven't seen all year since that one-time pullback that we saw about a month ago in the NASDAQ. Now, this is concerning because, and I'm going to scroll down here, the FANGs are what have been leading this market. They have taken this market on its back. What are the FANGs? Facebook, right now down 0.8%. Amazon, down almost 0.4% and challenging its 50-day moving average. Apple, down 0.6%. It's been trading below, but in a very big grind right here, it's 20 and 50-day moving average. So the bulls haven't lost complete control, but there is some uncertainty. They need a catalyst. Netflix, been on a downtrend for the last 2 weeks, below its 20 and 50-day moving average. And then finally, Google. You see that Google is also under pressure. It's consolidating a little bit over the last 3 sessions, but below its 20 and 50-day moving average. So short-term and intermediate-term bulls in Google, in the FANGs in general, are under pressure. That not only put pressure on these individual stocks, it's also putting pressure on the NASDAQ itself, which has been the net leader. XLF, as I said, look at finance. The reason why you see that the Dow Jones and the S&P 500 have been holding up as well as they have is because of finance. XLF is the ETF that tracks finance. Another major sector that has been holding up because of finance as well has been the Russell 2000. The Russell 2000 is held above 1400. It did challenge it this session, but it's trading at 1412. It is down 7 points, but coming off its worst levels. And this is what's notable here. This is what you want to watch if you're starting to get concerned about the domestic economy here in the U.S., which is the Russell 2000. That's my canary in the coal mine, and I watch that very closely. This is how I monitor what's going on in the United States. So when I hear an EIA report, which is the Energy Commission that reports the supply of crude oil, whether we had a draw or whether or not we had a build. Well, today you saw that we had a draw of over 6.3 million barrels in the crude. We also saw that gasoline stocks, not specifically stocks, but gasoline storage, down 3.7 million barrels over the last week, and you saw distillates, a draw of 1.9 million barrels. So you're starting to see that there's a big draw, and you'd expect that at this time of year. It is the summer driving season. Production, though, is also up. You're starting to see that production is increasing. So we're resupplying almost as quickly, not as quickly as what we are drawing out. And imports are also down. So we're not taking in as much outside oil. So the bulls have, or at least the bulls on the short side of crude, which if we take a look at it, have been given a little bit of reprieve. And as a matter of fact, it's been trying to challenge its 20 and 50-day moving average. And after this EIA report, it has now resumed that upside. Let's see if it can get above this level of $46.91. So basically $47. That's the area that's resistance. Like I said, I still think that that $44, $45 level is that sweet spot, that base that needs to be challenged a little bit more. But crude looks like it could get some gusto, especially if it gets over that $47 mark on the West Texas contract. Taking a look at the metals, gold is down today. The precious metal has been under pressure for the last 3 sessions and continues to. The fear just isn't there, even though we have VIX up. What is notable is the precipitous drop in copper. That does warrant some caution potentially in the non-ferrous industrial metal. Industrials have been under pressure today. Take a look at XLI. But copper has been down the last 2 sessions. It's holding here at the 266 level, but watch that 262 level on that non-ferrous industrial metal. And bonds. Bonds continue to slide in price. You see that TLT has just basically cratered to 123. It has broken through its 200-day moving average today. It's 50 and 200-day, and it's 200 today. Bottom line is very bearish activity after what has been basically a very hawkish statement after the Fed minutes. You've heard hawkish statements out of the ECB, and you're starting to get a little bit of mixed statements out of the People's Bank of China, which is basically neutral as far as their policy is concerned, and the Bank of Japan, which does not see the inflation forecast that the ECB is anticipating, as well as here in the United States. But bonds are taking it on the chin. You have the 2-year down 0.9%, almost a full percentage point. The 10-year down 0.5%. and you have the 30-year, the longest end of the curve, down 1.36%. So some big price moves in bonds. That should translate into that money potentially moving into equities. We're going to watch that because as I am with my clients' money, it looks like the market right now is treating cash as a position. So until we get an opportunity that's very clear, people aren't plowing their money into the markets as quickly as they normally would, especially now that we're in a part of the investment season where it's not a lot of participants sitting on their desks this week specifically, and going into the remainder of July and August, there's a lot of stuff going on. Of course, we're watching the Korean Peninsula very closely. A lot of rhetoric, a lot of testing going on there with ballistic missiles and show of force. But the point being is that we're a headline away from markets starting to move, but the bonds aren't showing it. Bond prices down, yields go up. That means that the fear factor is not plowing into the bonds. We're not seeing it in gold. It's got to move somewhere. We're going to keep an eye on the equities that are under pressure right now. As I always say, you buy on weakness and you sell on the strength. Let's see what's going on here and keep an eye on MarketStream.live. By the way, this afternoon at 1:30 Eastern, 12:30 Central Time, if you're worrying about or wondering, hey, you know what? Do I have enough saved up to retire? Could I retire in my 20s, 30s, 40s, 50s, and so on? We're going to go over in probably 15 minutes some pieces of information that will help you decide that and give you some context so that you really understand how you can utilize the stuff that we talk about, the strategies that we deploy, and this information that we give you so that you can better be suited to meet your financial goals going forward. So join us here at MarketStream.live. We'll talk to you soon. Take care.